Insider buying is a very bullish signal. It means that management think that the share price will go up in the near future. And in today's episode, we're going to look at 6 stocks that insiders have been buying. We're going to run through each one's historical performance. As always, we're going to take a look at their dividend safety. We'll look at their financial metrics, see how well positioned they are for the future. And as always, we will run each one through the valuation model, getting to the intrinsic value as well as our acceptable buy price, given our investor margin of safety, and look towards Wall Street to see what they are forecasting for the next 12 months. Now, our criteria for these stocks, as we can see here, we've looked for any insider buys, at least 100 shares, market cap over 5 billion, and this has to be within the last 2 months. So we're going to take a look. Remember, insider buying, we do see this as very bullish. So the first one is Occidental Petroleum Corporation, oil and gas industry. Now, it has been down around 6.5% over the last year. It's currently trading right there towards its 52-week lows. It has a forward yield of 1.26%, and we can see a forward P of just over 15. If you've been holding this company over the last 10 years, well, you would be down negative 37%. And whilst it doesn't include those dividends reinvested, that is a very poor return on any investment. So dividend safety score 60, it is borderline safe. It is a market cap 51 billion, a large cap company. Now, when we take a look at those recessionary metrics, a lot of people do see a recession inbound. Well, they increased the dividend during the last recession. Below average growth, negative 42% versus the S&P's negative 12%. But they did significantly outperform the S&P with a negative 23% recession return versus the S&P's negative 55%. In terms of dividend growth, a phenomenal double-digit 22% increase just this last month, in fact in December 2023. However, do note they did cut their dividend, hence why we see a negative 30% average over the last 5 years. Last 20 years looking pretty flat. We can see from this graph they did cut the dividend in 2019 as well as 2020. However, we do see a big jump, 22% in the last year. So they have only been increasing those dividends for the last full year. In terms of dividend yield theory, as always, it states a company is undervalued when the current yield sits above the 5-year average. So we have a sign here of undervaluation, 1.53% versus 0.88%. Bear in mind, we don't look at any of these models in isolation, and we do note the forward PE does sit higher than the 5-year average. And when we compare it to the energy sector PE of 12.0, Oxy does sit marginally, or in fact significantly higher. So let's take a look at the payout ratio. As always, we do focus on the free cash flow. For new viewers, the earnings is susceptible to manipulation by management through accounting. We run through a lot of examples showing that. For oil producers, we can bring it down to 40%. My personal preference is anywhere below 60%. Gives me faith that management can offer double-digit increases. We can see in the last full year, 2022, 4% on the free cash flow. 2023 expected 9% when the annual report is out. 2024 at 16%. So I would expect in December of this year to see a nice double-digit increase to the dividend. In terms of the free cash flow per share, it has been growing, but do note the inconsistencies. $6 in 2013, more than double in 2022, although 2023 it is expected to drop, as well as 2024, hence why we can see that share price has been heavily hammered over the last few years. In terms of the top line growth, do bear in mind the industry that we are looking at. This is oil and gas, very cyclical, very volatile. 2013 to 2016, negative growth. To the next 3 years, positive double digit, and so on and so on. It is very cyclical. 2023 down 19%. Remember, the whole point with these cyclical companies is that you want to be buying them when they are out of favor, when the share price is at rock bottom, and then be riding them into the cycles. So total sales numerically, 20 billion in 2013, 30 billion expected in 2023. Now, whilst we love it when companies do share buybacks, returning excess cash to investor pockets, we do know they have done the opposite on the long term. They have diluted your position. 805 million shares outstanding. In the latest quarter, 971. ROIC, now look, everyone has different numbers and different metrics, what they like. This is one of my favorite ones. I want to see a minimum of 10% or more. Gives me faith essentially that management are able to effectively allocate their capital. A lot more volatile as we can see year on year. The last 2 years though looking fairly positive, something probably just to keep an eye on. In terms of the margins, well, we can see again, this is just the nature of the cyclicality industry. We see very nice margins year to year. Sometimes we even see negative margins. Last 3 years, however, have been very well in terms of the operating margin. And the same can be said for the free cash flow margin. It does look to be a lot more stronger. The operating margin is something you may want to consider looking year on year. In terms of the net debt to EBITDA, now this is a very strong metric that helps with that dividend safety as well as just a very quick snapshot of the balance sheet. EBITDA, earnings before interest, tax, depreciation, amortization. And what this shows us is the number of years it would take the company to pay off all of their debt net of cash on hand. 2022, 0.88 years, 2023, 1.27 expected, 2024 to go even higher. Now our maximum is 1.5, so we can see with this edging higher and higher year on year why that dividend doesn't look to be very safe but classified as safe. Just something to keep in mind. So let's jump into the valuation of Occidental Petroleum. As always on the channel, we do run through deep dives of each company, going through each model. For today's episode, let's jump straight into the intrinsic value. And as always, if you do enjoy the content, value is being provided. Smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Margin of safety then, typically we start off with 10%, which we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. For OXY, we do see 10% up to a buy of $59, at 15% around $56, so it's not quite there yet. So for Occidental, we see around 10 to 15% margin of safety. In terms of Wall Street, well look, they have a price target of $68.40 above our intrinsic value, so they see upside of 19%, so they do believe, similar to Warren Buffett, they see this as a strong buy, as he has been adding this a lot, in fact, quarter on quarter. As always, when we run through these companies, do let us know your thoughts in the comments below, whether you are adding any of these or whether you are looking for a much larger margin of safety. Moving on to the next stock, which insiders continue to buy week on week, it is KDP, Keurig Dr Pepper. Now this is down 12% over the last year. Over the last 10 years, however, you would be up 284%. Again, just bear in mind it doesn't include dividends reinvested, so if you are reinvesting your dividends in KDP over the last 10 years, it would be higher. They are in the mid to lower end of the 52-week range. The yield sits just under 3% with a forward PE of 17.5. In terms of dividend safety, a score of 70, it is safe. Market cap 44 billion, a large cap company. In terms of recessionary metrics, well, they didn't pay a dividend, so we have no comparative data, but they had plus 44% recession sales, well above the average growth. Latest dividend increase came in September 23 at 7.5%. Nice to see the above inflation increase. But we do know they have cut the dividend a few times over the last few years. Something just to bear in mind. They've increased the dividend 2 years in a row now, and they did maintain it in 2019 to 2020. So in terms of the dividend yield theory, we can see here a double sign of undervaluation. Yield much higher than the 5-year average, with the forward PE much lower than the 5-year average too. In terms of the sector PE, well, consumer staples is higher at 19.5. Looking at that free cash flow payout, what we can see is, whilst for the last few years it has been in fact well below 60%, 2023 it is expected to inch slightly higher to 85%. Positive news, 2024 they're expecting to bring this down. So possibly this year the dividend increase may not be as high as the 7.5 we just most recently saw. Free cash flow per share. Now this is one thing that I don't like to see, a decreasing free cash flow per share. You want that to be increasing year on year at a very, very minimum, just remaining flat, but we always want to see growth. So just something to point out, and we can see in 2023 it is expected to go lower, although 24 we are expecting to see a bounce back, still below the last few years however. Sales growth 3 to 7%, remember, year on year. In fact, over the last 6 to 7 years it has been performing just that or even better. 2023, 8% increase, that is nice to see. They are in fact increasing higher than that target of 3 to 7%. Numerically speaking, nearly 3 times their top line over the last 10 years, 4.7 billion to 14.1. Again, this isn't what we like to see. They have diluted your position over the last 10 years. That share count has been increasing from 160 million to 1.42 billion. Now, when we look at the ROIC, again, this is one of the reasons why this wouldn't be a company that I would personally invest in. Just that ROIC figure is very low. Now, this isn't the only metric I don't like. There are a few others. But really, I want to see at least a minimum of 10% year on year. You could argue it is very consistent, although even having said that, we can see some years where it does drop very low. Operating margin, free cash flow margin, however, it does look positive, above that 16%, above the 7% consistently year on year. So that is nice to see. As I always mention in these episodes, consistency for good metrics is always a strong positive. On top of that, the net debt to EBITDA, what is nice to see, it has been decreasing over the last 10 years. 3.14 in 2022. It is expected to go slightly higher in 23, but then come back down, and we can see it is below that 4. So there are no real worries with that dividend safety. Likewise, no real red flag indicators for the balance sheet. So in terms of the analysis or the valuation for KDP, we can take a look to get to the intrinsic value, which for today's episode comes to $36. As always, if you do want to grab a copy of the valuation model to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio or on your watch list, you can click on the pinned comment below. Margin of safety there at 10%, it is a buy up to $32.30. 15% we can see not quite there yet. So very similar to Occidental Petroleum, it has between a 10 to 15% margin of safety. In terms of Wall Street, well, they see actually a little bit more upside than OXY, which was 19%. For Dr Pepper, they see around 21%, with a price forecast of $37.50 over the next 12 months. Now, before we jump into the next stock, just to let you know, we have released our most recent newsletter around the yield on cost. We are about to do a newsletter this week discussing some very hot topics in the market, and you can see previous newsletter editions that you can subscribe to and read. This is all completely free. If you do want to grab a copy, click on that pinned comment below. The next company now with a lot of insider buying is Agree Realty Corporation. Now, this is down 22% over the last year. Over the last 10 years, however, you would be up 96%, and we can see it has hit its all-time highs a few times at around that $80 mark. Now, it is towards the lower end of the 52-week range with a yield of over 5%, and we can see a forward P to FFO of 14.77. Dividend safety score 70, it does look to be safe. Market cap 5.84 billion, mid-cap company. Now, things to note here, the last recession they did cut the dividend. They also had average growth during the period and also trailed the S&P negative 67%. Dividend growth, yes, we don't like to see this, below inflation at 1.6 in October last year. However, over the last 5 years, it has been at 7%, and we do note the last 20 years, in fact, slightly under inflation. In terms of the number of years, well, they have increased those dividends for the last 10 years. As we can see here, they did cut that dividend in 2010. So let's take a look at dividend yield theory. We have that sign of undervaluation, both on the yield 509 versus 381, and likewise on the forward P to AFFO at 14.3. And we can see it is very, very marginally higher than the real estate at 13.7. So now with REIT, regular viewers know we ignore the free cash flow. It is a lot more volatile for REIT, so we look at the adjusted FFO, funds from operation. Below 90% is the target, and we can see here consistency around the mid-70s. Very, very nice to see. 2023 and 2024 expected to be more of the same. In terms of the adjusted funds from operation per share, very nice to see consistent increases year on year. Again, similar to the payout ratio, we do see 23 and 24 expected to be more of what we like to see. Very nice to see the adjusted funds from operation per share growth looking very positive over the last 10 years. 2023, 2024, 3 to 5%, still nice for this company. And their top line has grown more than the 5 to 10% we look for as a minimum in the REIT industry, in the 20s and 30s consistently. A lot of consistent natures here with this company, always positive to see. For those that like to see the numbers, they've nearly 10 times their top line over the last 10 years. And whilst don't let this scare you, this is very typical with REITs. They do issue a lot of shares. Your position is diluted. Now, yes, some REITs do dilute your position quicker than others. ADC is one of those that do dilute your position at a much faster rate. But as always, if the adjusted funds from operation per share is growing at a positive, strong rate, then that isn't the biggest worry there. ROIC, now what we like to see for REITs, 3 to 5%, unlike other companies at 10%. Now, yes, it is between 3 to 5%. The only thing I don't like is the decreasing nature of this, so this is something I would keep an eye on, although we do note the last 4 years at 3%. Hopefully that should be the minimum, and we should expect to see it start to go back up in the meantime. Operating margin, very nice to see, very strong. It has started to decrease over the period. Again, something just to keep an eye on, not necessarily something to worry about, but just something that I would add on the list of watch list items. Net debt to EBITDA for REITs 5.5, 2022 around that, 2023 expected again around that, 2024 coming a lot lower. That is nice to see. Dividend does look to be safe. Again, no real worries here with the balance sheet. So let's jump into the valuation of Agree Realty Corporation, and we can see for today's episode the intrinsic value is arriving at $67. Now with the price at $58, margin of safety at 10%, it is a buy up to 60. 15% not quite there just yet, so around 10 to 15% similar to the previous two stocks. In terms of Wall Street and what they forecast, again, very nice strong double-digit upside, 17% over the next 12 months with a price target of $68.44. The next stock that we have on the list is Consolidated Edison. Now this is down 4% over the last year. Over the last 10 years, however, up 63%. It is in the mid to lower end of the 52-week range with a yield of 3.7% and a forward PE just under 18. Dividend safety, we have a very safe dividend score of 90, market cap 31 billion. It is a large cap company. Now bear in mind all these companies that we have gone through are those that insiders have been buying. Key metrics then, they did increase the dividend during the last recession, above average growth in -7%, and they also outperformed the S&P -26%. Dividend growth, they increased the dividend just a few weeks ago, 2.5%, again not the greatest. Last 5 years 3%, last 20 years 2%. So always bear in mind what type of company you're investing in, have realistic expectations. And they are 2 years away from becoming a dividend king. They currently have dividend aristocrat status as they've increased the dividend for 25 years or more. When that turns into 50, they will become a dividend king. In terms of dividend yield theory, we can see a sign here of slight undervaluation, 3.7 versus 3.58. Likewise, forward P below the 5-year average. And we can look here that the utilities is slightly lower at 15. In terms of the payout ratios, then we can see, given the utility company, the utility industry, in fact, that this is in, this is essentially more volatile, so let's draw your attention to the earnings payout. It is below 75% consistently, which is the maximum. 2023 and 2024 expected to go slightly lower, which is always positive to see, a lowering earnings or free cash flow payout. It is positive. It means that ideally they will be increasing those dividends at a much faster or higher rate. Earnings per share, not as consistent as maybe we would like, but over the longer period, it does increase year on year. And you always have to understand and have realistic expectations, especially with utility companies. They're not going to give you the return or the increases that maybe you would expect from technology companies. We then see the sales growth, again, cyclicality, volatility, although the last 2 years were strong double digit. 2023, however, just a 1% increase to the top line. Numerically speaking then, 12 billion to 16 billion over the 10-year period, and shares outstanding, it is very common, similar to REITs, for utilities to dilute your position over the longer term. As we can see, this is to fund their growth expenditures, 294 to 351. So let's take a look at the ROIC. Again, for REITs 3 to 5%, other companies 10%, for utilities around 7 to 8%. It has been decreasing over the period. The only positive to note is the consistency around 5%. But again, if this is something you're looking to invest in or you are an investor, keep an eye on these metrics. Operating margin, very positive. It is very consistent and straddles around that 18% minimum we look for. And when we finally get to the net debt to EBITDA, below 5.5 for utilities, 2023 at 5.13 expected, 2024 expected to go lower. Again, no real red flag indicators. One, with the dividend, which looks to be very safe as per above, and two, the balance sheet as well. So what about the valuation for Consolidated Edison? Let's get into that. So the intrinsic value for today's episode is arriving at $104. Now, in terms of a margin of safety at 10%, we can see it is a buy up to $94. At 15%, around $1 shy. So for Consolidated Edison, ticker symbol ED, we do see around a 15% margin of safety. Now, in terms of Wall Street, their price target, interestingly, is only $92. They see upside of 2%. which is always interesting, especially when insiders are buying. As I said, it does look to be a bullish signal. As insiders do buy, they do expect the share price to go up. So it will be interesting over the next 12 months to come back and see whether or not Wall Street was correct in their forecast, or whether those insiders who are much more aligned to the business see something that Wall Street necessarily don't see. We then move on to another REIT, Simon Property Group. Now this has been up 11.5% over the last year. Over the last 10 years, however, it has been down 5%. We see its all-time highs at around $230 in 2016, and it did drop significantly in that pandemic down to $48. It is now trading towards the upper end of the 52-week range. As we mentioned, these are all companies that insiders have been heavily buying. A yield of 5.5%, forward P to FFO of just under 12. Dividend safety, borderline safe at 50, market cap 47 billion. It is a large cap company. Now, in terms of those key recessionary metrics, well, they cut the dividend during the last recession, above average growth, and significantly out or under, in fact, performed the S&P, -71 to -55. Dividend growth, last full year 18%, although we do note they did cut that dividend over the last 5 years, hence why on average -1%. Last 20 years, though, above inflation is always good to see at 6% for REITs. So over the last year, or in fact over the period, they have only increased that dividend streak for 1 year. As we do note here, in 2008 they cut the dividend, as well as 2009 and 2019 and 2020. So let's take a look at dividend yield theory. We see a sign of reasonable valuation, 5.44 versus 5.7, although you could argue slight overvaluation. Forward P to AFFO slightly higher, 13 versus 11.5. And we see here, though, it is still lower than the real estate sector P to AFFO. Now, in terms of the adjusted funds from operation payout, it is a bit more inconsistent. Nonetheless, for the majority of the period, it is below that 75%. Although we know in 2023 and 2024, it is expected to go higher to 71%. Adjusted funds from operation, a lot more inconsistent than maybe we would like. 890 in 2014, 1110 in 22, although expected to go lower in 23, and then rebound slightly higher. So very inconsistent for this group, the Simon Property Group, in fact, and we can see that clearly with the adjusted funds from operation share growth. Year on year, it does look a lot more volatile and inconsistent. In terms of the sales growth, again, this is a REIT. Do not expect large increases to the top line. We do see that pandemic drop in 2020, although we note the years subsequent or after that, in fact, have been slightly better. 3% in 2022, 7% in 2023. So let's take a look at the numbers. It has gone from 4.9 billion to 5.66. You could argue, however, when you incorporate inflation around 4% year on year, in terms of real increases, it is look fairly flat. In terms of issuing shares to dilute your position, one of the best that don't do it as much as the likes of Realty Income and ADC that we saw earlier, 311 in 2014 to 327 in the latest period. ROIC, very strong for a REIT. Remember, normal companies, we want 10% or more. REITs, 3 to 5%. 9% over the last 2 years, so that is nice to see. And it has been high, in fact, as 11% in 2018. Now, the operating margin is looking positive, consistently around that 50%, which is always nice to see consistency. Net debt to EBITDA, now this is why we have that borderline safe score. It is pretty much straddling around 5.5 year on year. In fact, it went very high in 2020. The best thing to note, or the better thing to note, is has been decreasing since then, although even in 2024 it is still expected to be higher at 6.11, so something just to keep an eye on. There are a few red flag indicators that we have gone through for Simon Property Group, so it is one I would bear in mind if you were looking to invest in. Now, let's get to the valuation for SPG, and for transparency, this isn't one that I personally hold in the REITs sector, only due to the fact that there are some red flag indicators through the metrics that I don't like, but everyone has different opinions for different reasons. So intrinsic value is coming to $178, margin of safety at 10%, we do see an acceptable buy up to $160, at 15% $151, at 20% it is only around $1 shy, so we do see around 20% or up to 20% margin of safety for SPG. In terms of Wall Street, well, their forecast is $170, so whilst this is near the 52-week high, they do still see upside of 19% over the next 12 months. So let me know if this is one that you do hold, or maybe you are considering to add or even sell because it's near the 52-week high. The next company that we are taking a look at is SJM, the JM Smucker Company. Now, over the last year, it is down 13%. We've seen the midpoint of the 52-week range, yield of 3.2%, a forward PE just under 14. And if you've been holding this over the last 10 years, very inconsistent, although you would be up 44%. And we do see it near its all-time highs of $163 at the beginning of last year. Dividend safety score 80, it is safe. Market cap 14 billion, it is a large cap company. Recessionary metrics, well, they increased the dividend in the last recession, above average growth, and also outperformed the S&P with the negative 27%. Not a bad increase, pretty much in line with inflation last summer. Last 5 years and last 20 years looking a lot nicer at 8% year on year. And in terms of increases, they've been increasing the dividend for 21 years, 4 years away from becoming a dividend aristocrat, and they have been paying without a reduction dividends for 51 years. In terms of dividend yield theory, where we have that sign of undervaluation, 3.21 versus 3.05. Similarly on the forward PE, 13.7 versus 14.5. And when we compare it, consumer staples is much, much higher at 19.5. So let's take a look at the free cash flow payout. Now, below 60% is my preference. A lot of people bring this down to 70% for consumer staples. The last 2 years looking positive, 60%. 2024 expected to go slightly lower. So I would like to see a much nicer, high, in fact, single-digit dividend increase this year. Free cash flow per share, now whilst it has increased over the period, very inconsistent. 2024 it is expected to go higher, but do note the inconsistencies from year to year. Sales growth, not really what you want to be seeing. You want to see 3 to 7% year on year. 2022, 0%, 2020, 0%, 2021 at the lower end, and we do see, even going far back to 2014, 2017, negative growth. So numerically, 5.6 billion to 8.5 billion. In terms of shares outstanding, they've done it all. They've issued shares. They've, in fact, bought shares back. 104 million in 2014, 104 million in the latest report. So net position, it hasn't really moved. But just interesting to note that they have done share buybacks as well as issuing shares over the period. ROIC then, 10% is what I'm looking for. This would be acceptable for me at the bare minimum, 10, 8, 9% year on year. It hasn't dipped lower than 8%. 2023 at 9% again is nice to see. Operating margin, now yes, it has been straddling around that 16%, although we do know over the more recent period it has been dropping. If consumers are being squeezed, then it may face SJM or JM Smucker to lower their prices to entice more customers, and this will affect their operating margin. Something just to keep an eye on. Free cash flow margin, however, consistently looking fairly decent. Net debt to EBITDA then, nice to see it has been decreasing. Always good to look at trends, try and spot and see what you can find. 2024 expected to go lower, so I would expect the dividend to be safe and no real issues with the balance sheet on a high level look. Now, in terms of the valuation, and as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe button, and don't forget you can grab a copy of this valuation model by clicking on that pinned comment below to get to the acceptable buy price of companies in your own portfolio and on your watch list. Margin of safety then for SJM at 10%, not too far off the current trading price. So again, we see around 10 to 15% margin of safety for this company. In terms of what Wall Street expect, well, they have upside of 8% over the next 12 months with a price target of $143. As always, do let me know your thoughts in the comments below. Are any of these you are looking to buy? Do you also, when researching stocks, look at insider buying? Do you see it as a bullish signal? And what I would be interested to know in today's episode is whether or not you do use Wall Street forecast price as part of your investment thesis. In my opinion, I don't look too much towards what Wall Street say. If you've noticed with trends, when companies are going up, they always tend to keep revising their price targets to go higher and higher and higher as the share price goes up. And the opposite is also true. If a company suddenly crashes, Wall Street will then change their price forecast after it crashes. So again, something just to consider. They are more reactive than proactive. So for me, whilst I do add it in so you can see, for me personally, this isn't something I pay too much attention to. As always, have a great day. Enjoy. See you on the next one. Take care for now.